Good morning, everyone. Thank you for joining us for this cover talk this morning. My name is Andrew Tobin. I'm a partner specialising in insurance and reinsurance at Mills & Reeve, and I'm delighted to introduce our speaker today, our Senior Associate, Charlotte Clarke. Charlotte is qualified as a solicitor in both England and South Africa. She works in the London Insurance Disputes team and has a wide range of experience in insurance matters, including coverage and defending claims against policyholders under liability policies. Charlotte's practice areas within insurance disputes include construction, professional indemnity, directors and officers, property and business interruption. Charlotte will speak in our usual short 20-minute format on the topic of underinsurance, which is very relevant to us all in this high inflation environment. And as usual, this session will be recorded and a copy will be available afterwards. If you have questions, please put them in the question answer box where they'll be collated for us to address at the end. But just to get matters rolling, I'll mention a few statistics. A recent Aviva report, 2023, mentioned that 66% of SME businesses considered their sums insured to be inadequate. Sedgwick have recently said that 80% of SME businesses are uninsured, and between 21 and 22, they said that 85.5% of commercial properties were underinsured by an average of 28%. And the last one on the slide is Charterfields, who said that 42% of plant and machinery was underinsured by more than 50%. And all that data is probably can be considered historic now. They don't take account of what can be called the perfect storm of factors since then, including the war in Ukraine and the global energy crisis, which has resulted in a major spike in inflation that looks set to last well into 2023 and beyond. And while the headline rate of inflation has been floating around 10% since October 2022, the value of some goods and materials, particularly in the construction sector, has increased many times, perhaps between 50 and 100%, well above the rate of inflation. So very many businesses in the UK were insured, and more of them are now underinsured. So if the current global situation continues, more and more businesses might find themselves underinsured. If the value of a property, for example, declared in a policy is incorrect, this may result in the property being considered as underinsured, which will have an effect when they come to try to make a claim. But enough from me, over to Charlotte.
Thank you, Andrew. So just to start with some context, in December 2022, the FCA issued a warning to insurers, cautioning them not to undervalue insured assets when settling insurance claims. This is quite a clear message from the FCA to insurers that they need to be perceived to be fair to policyholders in claim situations. So understandably, insurers can only price as accurately as the data that they receive, but prices are rising all around us. And to ignore this and to place commercial business based on old sum insured values is at best naive and at worst possibly poor practice. So when we talk about underinsurance, we usually talk about the average being applied. The Marine Insurance Act, Section 81, provides for statutory application of average, which is if the property is insured for less than the insurable value, the insured is deemed to be his own insurer in respect of the uninsured balance. The general rule then in non-marine insurance is that if there is no average clause in the policy, insurers will be liable for any loss up to the limit of indemnity, and the insured will only be self-insured for any amount in excess of the limit of indemnity. However, these days, it's quite common in non-marine insurance that the application of the average is determined by the policy wording and the existence of what's called an average clause. So if average does apply, either by virtue of the policy wording or by virtue of the Marine Insurance Act, if it's a marine policy. And if the sum insured does not represent the value of the property insured at the time of the loss or damage, the insured is deemed to be its own insurer for the uninsured portion of the claim and bears a percentage of the loss. So when an insured self-insures for a percentage of the loss, the amount of any claim will be reduced by that percentage. This is even where the limit of indemnity is sufficient to cover the loss. So for example, if the value of a property is £10 million, the property is, however, only insured for £7 million. This could be because the value of the property, for example, was incorrectly stated at policy inception, whether by error or for a cheaper premium. Or this could equally be because the property was only worth £7 million at the time of policy inception and is actually now far more expensive thanks to inflation and thanks to the cost of living crisis. So let's say, for example, that the property is damaged to the tune of £4 million. Here we can see that only 70% of the property value is insured. After applying the average, insurers will only pay out £2.8 million. The insured is therefore its own insurer for 30% of the loss, even though the limit of indemnity is sufficient to cover all of the damage to the property. And in fact, the claim is only about 57% of the sum insured. Insurers will still only pay out 70% of the claim, as this is the portion for which they have insured the property. The insured has to pay out their own portion, 30% of the claim being £1.2 million. So note here that the claim will be reduced even further by the policy excess, because this is only deducted after the claim has been reduced by average. So an insurer may have an argument to say that the underinsurance is so significant that the risk has not been fairly presented, whether deliberately or recklessly, maybe even entitling insurers to avoid the policy, refuse the claim, or keep the premium. Under the Insurance Act, a fair presentation of the risk is one which discloses every single material circumstance which the insured knows or ought to know. An accurate value of the property insured is a material circumstance which must be disclosed to an insurer. It's been questioned, however, whether the value of the property insured is in fact material, where the policy contains an average clause. And this is because in any event, the insured would bear a share of any loss and the insurer wouldn't be disadvantaged. The argument to the contrary, however, is that the value of the property is very important in calculating the applicable premium. The presence of, say, for example, very high value property might have a bearing on the risk of theft. So this is something to consider. Where the property insured is incorrect because of external factors such as inflation, supply shortages, etc., this non-disclosure may be innocent. It'll still be a non-disclosure, though, with the Insurance Act remedies available to insurer, such as the application of alternative terms, the application of a higher premium and resultant reduction of the claim, or an avoidance of the policy and a return of premiums. So while it may look like underinsurance is the problem of the insured, especially where the policy contains an average clause, in truth, if policyholders are actually underinsured to the extent that they are reported to be, insurers are missing out on the benefit of millions of premiums, while at the same time facing this possible scrutiny from the FCA for failing to treat customers fairly. So, as I've said, the FCA has made statements which indicate it takes a very dim view on insurers applying the average, where the sum insured very clearly does not meet the needs of the insured. So turning to business interruption for a minute, the Chartered Institute of Loss Adjusters estimates that 52% of business interruption policies are underinsured, with an average shortfall of up to 60%. So this is a topic of much debate. It may even warrant its own cover talk session. Business interruption is a particularly problematic area because the calculation of a sum insured can be very complex. How does the insured determine whether the indemnity period or the sum insured is sufficient? So another issue when calculating the sum insured on, say, a gross profit basis, the insured will often look forward to the 12 months following renewal or inception to see what sum insured they need. The problem here is that where damage occurs later in the policy year, as a result of inflation, the sum insured may be insufficient to cover the gross profits for these following 12 months. For example, what we see here, if gross profits are estimated for the 2022-23 policy year with a 12-month indemnity period, what if the damage occurs in, say, December of 2022? This means that the 12-month post-damage period will extend well into 2023. Imagine the difference in turnover, the difference in gross profits, the difference in cost of working between 2022 and 2023, especially, for this period. In this way, the sum insured is far less than the gross profit which would have earned, and insurers' liability will be reduced proportionately. So with rising labor costs, material shortages, indemnity periods in business interruption policies might not be long enough to cover the extended delays required for reinstatement because of these materials and labor shortages. In some cases, 36, even 48-month indemnity periods are necessary. So to make sure the sum insured is adequate, the insured will need to consider things such as the length of time to get a site which is damaged cleared, the length of time to get plans drawn up and architects and contractors appointed. This is before any remedial works even starts. Will planning or other permissions need to be agreed? Can the work be subcontracted, or does the insured risk losing their customer to a competitor? It should need to consider delays or extra costs involved in sourcing damaged or lost specialist pieces of plant machinery. At the moment, there's a large shortage on this kind of machinery. Could any seasonal trade on which the insured is dependent be affected? Have staff salaries been considered as part of gross profit sum insured? Without maintaining salaries, staff may leave, adding to the problem of incurring additional costs in employing new staff. And also, is there a well thought out contingency plan in place? This can be incredibly tricky when it comes to pricing. So in the current hard market, insurers obviously want to keep premiums competitive. But by conducting detailed assessments of sum insured, it's inevitable that premiums might increase to cover the cost of inflation. So finally, I want to make a quick reference to D&O cover. There is an emerging risk for directors concerning allegations of greenwashing. Greenwashing is where a company makes unsubstantiated, exaggerated, or misleading claims about its environmental or social impact. A significant drive towards sustainability, as well as government and regulators cracking down on greenwashing, could drive a massive future wave of D&O claims. From a regulatory perspective alone, those who trade publicly have been required to make climate-related disclosures about their ESG approach since before March 2022. So while we unfortunately don't have time to go into this in any real detail, we note the current high-profile ongoing litigation against 13 directors of the energy giant Shell. This case is a really good indication of how a single greenwashing accusation has the potential to exhaust an entire D&O limit of indemnity, possibly on defense costs alone. So the implications as well of underinsurance in a D&O policy for a director personally could be possibly catastrophic.
Thank you, Charlotte. So whilst underinsurance is a perennial issue in this high inflation environment, it's becoming a much more significant one in connection with the handling and settling of claims, and something that insureds, their brokers and insurers all really need to focus on. And it looks like we've finished in time, so we do have some time for some questions. Harriet, have we had any questions?
Yes, thank you very much indeed. Charlotte, What about where the insurers knowingly elect to self-insure a portion of the loss? So, for example, if the insured's business is cash or capital rich, what impact might that have?
So, I mean, generally, if the policy contains an average clause and the insured knowingly decides to self-insure a percentage of the loss, the application of the average means that sort of technically the insurers are not disadvantaged by this decision. But I think it should be noted what was mentioned earlier, that there is a duty to make a fair presentation of the risk. So the value of the item of the risk is material. It's something which really needs to be disclosed to insurers to fairly present the risk. And the value of an item can obviously have an effect on how the insurer will perceive this risk. So as far as going into remedies for this kind of a failure to disclose the value of the thing insured, this would go per the normal process for a failure to make a fair presentation of the risk. And it would be very much dependent on the input of an underwriter as to whether the risk at the actual value, the actual higher value, would have been insured on the same terms. In many cases, it probably would have been insured on the same terms, but a higher premium would likely have been charged, and then the amount of this higher premium would be deducted from the claim. However, you know, if the value of the risk is sufficiently understated, let's say by 50%, even 70%, the insurer might have refused to insure the risk. This could result in the policy being voided. And then where obviously the breach by the insured was deliberate, which it seems like in this case it would have been if the insured was electing knowingly to self-insure, this would be a deliberate breach, and the premiums might actually be retained by insurers because, as we know, an insurance contract is a contract of utmost good faith. So I think in this situation, it's quite a dangerous thing to undertake, to knowingly and willingly self-insure, especially where the actual value of the risk is kept quiet from the insurers.
But do you think that there's a level of underinsurance which is acceptable, for example?
So, I mean, it's very likely that a small percentage of underinsurance will not constitute a breach of fair presentation, and even if it does, if it's linked to inflation, it wouldn't be deliberate or reckless. So insurers would have limited remedies available to them. But where we're talking about 5-10% difference in actual value in sum insured, that's unlikely, as I said, to be a breach of the duty to fairly present the risk. However, there is, if the property is something which values fluctuate significantly during a period. For example, we use sort of agriculture, and the value of crops once they're being harvested can be worth up to 10 times more than the value when they're planted. So in this case, an insured would have to insure the entire years, the whole policy period, on this one value that they have. So what might be more suitable in this situation is something called a special condition of average, where the average will only be applied if the portion of underinsurance falls below a certain percentage. For example, 75% is something that we see quite often. This means that, as I said, there can be some sort of level of underinsurance which is acceptable to insurers, and that's usually if this special condition of average is in the policy.
So never a straightforward question, or answer, I should say.
It's never straightforward, and as I said, it's very much we get evidence and guidance from underwriters, and that's something that we always say is quite important for underwriters to write down their guidance and note their ideas and that sort of thing, because it's always nice to be able to go back and say, well, in the situation, insurers would never have insured such a massive risk, and that tells us everything.
Yeah, absolutely. Well, look, we're running out of time, and although we do have a couple more questions on the list, I shall pass the baton back to Andrew, as those who've left their addresses can be contacted afterwards. Andrew, over to you.
Thank you. So that concludes our presentation today. We'll pick up those further questions, as Harriet said, or if you would like to contact Charlotte or myself directly, then please do so by email or even pick up the phone for a chat. We really like your feedback and suggestions, so please do fill in the survey that will follow this presentation. Our next session will be on the 14th of September, after the summer holidays, when our speaker Tom Philby will be speaking about some trends in D&O insurance, and invites for that will be sent out over the summer. Thank you all very much. Have a great summer and goodbye.